This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes or Apple Podcasts, type in Old Dogs, spelled D-A-W-G-S, find our podcast, and subscribe. Well, we've got a great show for you today. We are going to be talking with Jason Perro. And Jason was born and raised in Erie, Pennsylvania, and attended college at nearby Westminster. After college, Jason began a sales career in pharmaceutical and medical device sales. He started his real estate investing career in 2001 when he and his wife purchased their first duplex. He built a portfolio of real estate rental properties while working a career as a medical sales representative. He was able to leave his job in 2012 as the portfolio had grown to nearly 300 units. Jason balanced the demands of a high-pressure sales environment, a young family, and growing a real estate portfolio. Upon leaving his day job, Jason continued to build his real estate holdings and currently owns around 900 doors. He is the president of his local landlord apartment association and a frequent guest on podcasts and occasional speaker at real estate investing conferences. Jason enjoys coaching and mentoring both seasoned and beginning real estate investors. He continues to grow his real estate business, but enjoys spending his free time working out, traveling, relaxing with family and friends, attending sporting events, and concerts. Well, Jason, welcome to the Old Dogs REI Network.
Thanks for having me, Bill. Really looking forward to our conversation.
Yeah, me too. Well, you've got a great story here, and I love to hear more about it, and just how you kind of eventually ended up in this real estate world.
Sure. So my story begins shortly after college. Where I grew up, I didn't really learn about money growing up. I mean, I had jobs and knew how to make money, but when I got out of college and tried to figure out what I wanted to do with the rest of my life, one of the things I quickly learned is I didn't want to work for somebody else forever. And so I was starting to read, business books and personal development books. And I, think like everybody in this business came across Rich Dad, Poor Dad, The Millionaire Next Door, kind of opened my eyes to, different mindsets and philosophies on how to create wealth or how to get rich. But I ended up, sort of different mentors and people that I looked up to, they would all come back to a very similar theme that most millionaires and most wealth is created through real estate. So long story short, that captivated me. I saved up as much money as I could to buy my first duplex. My wife had graduated college a year after that and started working. And so Early years, we just saved up, the old fashioned way, saved up our down payments, and, we get a 75 or 80% loan to value and save up again and do it again. And then, we just kept getting better jobs and earning more money. So we had more money to invest. And then as those investments started working, we would roll all the profit back into the business. And then, 2005, I met my real first mentor in the business who, sold me my first big deal. So we had accumulated up to 23 units at that point. And this guy was living the life that I thought was amazing. He had 127 units. He was selling off 56 doors. And he said, "Hey, look, I'll sell them for 1.1 million. If you come up with 10% down, I'll carry the paper." And I said, okay. I didn't know how I was going to do that, but I borrowed against my 401k. I cashed in some stock. I took lines of credit, had some cash sitting around, did everything I could to save up that money. And of course the deal worked, and he became a mentor, and we ended up buying more of his properties along the way. But that's kind of how I got my start. And we ultimately, especially in the early years, didn't take any partners. It was just my wife and I, for the better part of most of our real estate career. We've gotten into syndication in the last few years, but 2/3 of our portfolio we own together without any partners, and then the other third of the portfolio is stuff that we've syndicated in recent years.
And how many of those units? How many units do you own outright?
About 600. That's just my wife and I, and then the 300 that are syndicated with partners, with me as the GP and sponsor of the deal.
Gotcha. Now, the first home you in your bio says that your wife purchased her first duplex in 2001. Now, did you have your own home at that time, or was your first home a duplex?
No, it was interesting. We were renting at that time, so we were renting a place to live for about $500 a month, and we bought a duplex. I liked the cash flow from it. I said, "Wow, this duplex pays for one of my student loans." And then, over the course of the next year, I'm saving up money for our next acquisition. And we bought our first home at that point. In a week later, we bought our second duplex and a quadplex. Now, if I had to do it all over again, I probably would have house hacked and lived in one unit while the other one was paying the bills. But we didn't do that, so we just opted to start buying small multifamily right away.
Yeah, that's sometimes a tough sell with a wife too, that doesn't necessarily want to share their house. I mean, I know my wife wouldn't be real cool on the the house hacking idea, but that's okay. So those were the rental properties going while you were renting, which is really interesting. That is really cool. Now you gosh, you got up to 600 units while you were. You're just kind of building up your portfolio, which is pretty impressive. And those are all properties that you own outright. No partners or JVs or anything on those?
No, about 500. We just my wife and I, and then we have about 100 units that we have a hard money partner or JV, if you want to call it that has a little bit of equity in those 100 those 100 units, but kind of a short term plan. How we got into that. He was looking to earn a return on his capital, and we had a 5-year plan, which we're about halfway through on those units. Where at year 5 we'll refinance him out and and then own those outright. So for the most part, the vast majority is just her and I.
You've got such a tremendous number of units that you own outright. Why go into syndication? Where did that decision come from? Because obviously you sort of give up a little bit there. And
sure.
You kind of give me sort of the thought processes that kind of brought you to do your first syndication.
Yep. So I had, it's one of those concepts I guess I started thinking about and trying to understand, probably 10 or 12 years ago. And I got the concept, but it just never really clicked for me until a few years ago. And sort of a series of things had happened. There was, the podcasting world started blowing up, and then, everybody, was pointing me in the direction of, hey, you got to check this podcast out or check that podcast out. And I think some of the interviews were extremely helpful. So things started to make a little bit more, clearer sense to me, but I didn't really know where the benefit was for me. I never really had partners. We kind of call our own shots. So I was very skeptical and hesitant to have any sort of partners and have to answer to anybody else. But in that time frame, probably 4 or 5 years ago, I met and became friends with another local business owner. Very successful at what he does. His family had owned a potato chip brand for years. They sold that off 10 years ago. They still have a farm and they have quite a few other businesses. And but he had some real estate, and he had syndicated a deal back when they sold their potato chip brand, or shortly after that, in Florida. And so I got to understand a little bit about how that deal worked for them. We decided that, hey, we'd want to buy something or invest in something together. Really didn't know how that looked or what that would look like. But over the years, as we became better friends and realized what his strengths were and what my strengths were, that there's some very complementary skill sets. So even though we were both driven entrepreneurs, he has a background and skill set, and members of his team that are different and complement my background and my team a little bit differently. And so about a year and a half, 2 years ago, we came across an 86 unit property that, for all intents and purposes, I could have purchased myself, or he could have purchased himself. But as you know, at some point, you run out of available capital unless you keep tapping your reserves or refinance. But I think it sort of clicked for me, and I realized I don't have to go and refinance my portfolio and just over leverage myself. I can keep paying down on my debt. Ultimately, I can still maintain what I want out of the deal, which would be majority ownership, control of the deal. And I like that idea. So, I had to give up a little bit, but I didn't have to risk everything either. We were able to share in the risk, able to sort of connect with those family and friends and acquaintances who, over the years, that said, "Hey, if you ever come across a real estate deal, let me know." And I think of investing, but it never really clicked for me because the smaller properties I didn't want to take partners on, and then the bigger ones that I had owned, I never needed a partner. We would do a refinance or a 1031 exchange. But this idea just allowed me to keep growing without having to sell, without having to refinance, and still maintain majority ownership, be able to call the shots, and like I said, share the risk. But it allowed us to grow faster and further into a better product class. And then again, at the end of the day, when our timeline is up and we need to cash out investors, we're looking at properties that that I would like to hold even longer term than, say, a 5 or 10 year horizon. So as we keep paying off our other properties, hey, if this is a really great deal, I'd have no problem keeping that for the long term.
Gotcha. Now, are you and your partner, so you guys are sort of 50-50 GPs on that, or sponsors on the syndications? Yes.
Yeah. So we formed an entity that that is the GP, and we're 50-50 on that. So he brings a lot of experience and wisdom from at one point I think they had up to 300 employees. So he's got that just really good advice, really good insight in terms of scaling a business. As you know, when you start growing rapidly in syndication, which can happen quickly, there's that need to scale operations in a quick manner too. We self-manage, have quite a few employees. So it's nice having a mentor and a friend that has a vested interest in seeing me succeed. But we bring the operational experience. Because we do self-manage, we've got the team to handle that. He has a CFO that helps run all of his businesses, and she's a CPA by trade. A ton of great experience. So our complementary assets kind of balance each other out, and it's just helped us do some deals really quickly and without much pressure in terms of raising money, and just the strength of the two of us together is more than what just one of us would have, and that's kind of a nice feeling, knowing that we're that we have a strong presentation with a combination of both of our businesses, and then that reputation translates into opening up doors that perhaps either either one of us wouldn't have had open before.
Yeah, that's what really stands out to me is that sort of the organic nature of the whole process. That you weren't really looking for a partner, but you had this great acquaintance who was also very motivated and entrepreneurial, and you were able to there's like a synergy there, and then not only that, but then you already had this this growing demand from family and friends and whoever that were interested in investors. So you already sort of had a beginning investor pool. So you didn't have to really deliberately like go out, find a partner, that you could partner with and start banging on doors to find investors. I mean, I like how it was just a sort of a natural, organic kind of move there that it sounds like it's worked out really well for you.
Yeah. And and that's the thing, we were trying to force something early on, and I'm glad it did take that organic approach, because we were able to both be comfortable with each other, be able to really get to know each other and become friends first. And it's that first raise was interesting. It wasn't that big of a capital raise. It was about 1.5 million. But it was big enough when I hadn't done it before. But ultimately, it was fairly straightforward. The deal went off without a hitch, and then, several months later, we had our next deal, and things had kind of taken off from there. And that, of course, word spreads, and then people want to invest in your deals, and and then happy investors become repeat investors. So that's been going well, also. So we're just very comfortable with each other, and we know that, hey, the syndication thing's just a part of our business. It's not. It's not everything to him. He still pursues a ton of different entrepreneurial ventures, and we're still buying property in our own name, without partners and without syndicating. So just another kind of feather in the cap, another tool in the toolbox. But it's a fun business to be a part of, and just another challenge or another thing to try and figure out and master in this business.
Oh, sure. The first property you said the seller was willing to owner finance. Was that right? Did I hear you right?
Yeah, it wasn't the first property. So I had 23 units at that point, but
the first larger.
Yeah. First larger deal.
And how did that work out? Was that like a master lease? What kind of an arrangement did you make with them?
Well, no, we bought it outright. So we had the deed transferred to our name, and he was the bank. So he held $1 million mortgage for, it was a 25-year note, 6% interest, and with a 10-year balloon. And over the course of that 10 years, from 2005 to 2015, we had sold some property off. We 1031 exchanged into other property. I had subsequently purchased the rest of his portfolio, which is sort of another story in and of itself. But so yeah, the deed transferred. We made him a monthly payment. When balloon time came, we had to pay him off. But it was great because he was invested in my success. He treated me like another son or a little brother or something like that. But it seemed like we would get together, maybe once a month or so. And I'd be able to pick his brain on the business and how things were going, and kind of, he would tell me what he was up to. And I just soaked it up like a sponge, because I just thought he had, he was a guy that was able to, buy enough rental properties that he could leave his job and carry on with a really good life. So he was my first real mentor. And I didn't know it as much at the time, but really just taught me a ton about, just about the landlording business, but also the investment side of the business, which are all encompassing and all important. So that arrangement worked out really, really well. And that was the catalyst to do other owner finance deals. Once I left my day job, got into having hard money lenders and things like that. So had never really ventured into having, a partner or hard money or private mortgages and things like that until I left my day job and had the time to focus on like new, different and creative ways to structure deals.
Are you also doing some more conventional sort of Fannie Freddie type financing now?
Yeah. On all the big stuff, it's all agency debt.
Right.
which I wish I would have known about like 20 years ago. That would have been great. But yeah, I mean, when I would always hear people tell me, oh, it's easier to get a $10 million loan than it is a $100,000 loan.
It's the truth.
It's not entirely true because there's a little bit of paperwork involved, but
Yeah.
I mean, honestly, at least from my experience, it seems like it goes just as fast, if not faster. And yeah, that ease of which it can happen is great. I mean, there's other things there, obviously, like, liquidity and net worth requirements and, credit requirements. So that's where it does pay to have a partner or someone else you're kind of teamed up with. But yeah, some of our local banks, they take, longer to, write $100,000 or a few $100,000 loan than they, than a Fannie or Freddie loan can get done. And so, yeah, I wish I would have known about agency debt a lot sooner.
That's great. That's great. Wow. What a great journey. When you purchased, some of these properties, were you also sort of looking at sort of a value add approach where you would do some upgrades to boost the value of the properties, or was that not an issue?
Yeah. So early on, the earlier years, probably starting back with that big purchase in 2005, we would go in and, we'd buy distressed properties and be able to do the work that we could to raise the rents, and, of course, then affect the value of the property. Didn't really know the vocabulary of it back then. I think, it was more just just fixing and rehabbing properties. But, when we started buying things on a larger scale, that tends to be the approach more often than not, in terms of the ability to force appreciation. For instance, we just locked into a deal last week that it's 127 units and it would work really well in the turnkey approach. But if we go in and do just enough work to be able to raise the rents, then of course, we've enhanced the value of the property, and over a period of, for those first couple of years, we'll be able to drive up the returns to our investors, but also drive up the value and hopefully have a refinance or a sale at a much higher rate than what we acquired it at. So I think the value add is key in most of the things we're doing now, but not opposed to a turnkey purchase. I mean, sometimes the turnkey can be great if you just want, predictable, easy money coming in.
Yeah. Do you have any that are more stabilized purchases that you really don't have to do much to?
Yeah. Oh yeah. We continually buy property like that. So I had, I guess I'll qualify that with, there's always something that's going to change when a property changes hands. If you're changing management, in our case, we self-manage, there's always that element of, hey, it's going to take a little bit to stabilize in terms of our management. But, we always look for things that we can maybe add a little bit of value in that regard, even if the units are in great shape and the rents seem to be maximized. Sometimes I think in the long run, even a turnkey property, the rents will go up over the years. You don't have to really worry as much about the CapEx in the early years, at least. And I like that if the property makes sense and it's part of a good mix of other properties, say in a given area, more than happy to take over something that's turnkey because it takes a lot of the guesswork out too.
Oh yeah, I would imagine. And that's interesting too, that you're not just all syndicating. You're still looking for things for for your own personal portfolio. What are you buying on your own personal? I mean, are they under 100 units, or are you buying single family, or what are you primarily looking at?
Yeah, not as much the smaller stuff anymore, like the singles and doubles. I try to stay away from that, but 18, 20 unit types of properties, and generally I think in areas where where we have other properties. So last year I picked up an 18 unit and a 20 unit that were literally 2 blocks away on either side from another, like 2 sets of 16 units that we own. So then we have basically a 4 or 5 block radius with several like smaller multifamily buildings, but they're big enough that they can make predictable returns. I think, if you're dealing with a 10 or 20 unit, you can still underwrite that and predict that deal out pretty well. A lot easier than say a duplex that, when you're vacant, you're 50% vacant,
Right.
I think that kind of mid-sized property seems to work pretty well. And we'll take over a lot of times these mid-size, 30, 40 unit portfolios of properties, that maybe a mom and pop owned for 20, 30 years, and they're ready to get out of it. And that seems to be a nice sweet spot for us.
Sure. Now, are you still in Erie, Pennsylvania?
Oh yeah. Yes.
So are you buying all in Erie or in PA?
As of right now, that's we haven't had to venture out. Now I have a few contacts in the business that have we might be venturing out, into Cleveland and maybe some other markets. But right now we haven't run out of property to buy yet in our area, and it just seems like the returns are really good, in these tertiary markets. And I think it's a challenge. If somebody's investing from far away, I don't know that I would go into a tertiary market that I don't, that I can't live in or control. But the fact that we self-manage, I'm very comfortable with how these properties operate, what I can expect. We've been doing it long enough that if it's a good product and it's still in my backyard, I'm more than happy to take it over.
That is very cool. Well, Erie's not on a lot of radar, so it's
Right.
kind of neat that you've got this, this. Of course, now everybody knows about it, but no, but no, that's great though. I mean, you've been able to build a management team. It sounds like, what kind of staff do you have to manage the properties that you have right now?
Sure. Yeah, we've really expanded in the last several years. For the longest time, we had a property manager, had our maintenance team, and kind of built that organically over the years. That first big deal I mentioned earlier, that was kind of the catalyst to get my first employee. So it was a maintenance guy. But shortly after as I started buying more properties, I realized I needed a property manager. And so, kind of fast forward to now to, there's a little suburb of Erie that I have 140 units in. So I've built a staff down there. So I have a property manager, like a cleaning and maintenance staff to handle those units, because it became almost too cumbersome to have my guys. It's only 20 miles from our headquarters, but running back and forth every day. And now we have bodies that can be planted at those properties and have a better response time in terms of not only filling units, but taking care of existing tenants' needs. So we have staff there. We've got some properties where we have on-site staff. So we have one where we have some on-site maintenance and on-site property management. That's like a 200 unit complex. And then we have a operations manager who kind of acts as the head property manager and asset manager. We've got a leasing manager, a secretary, an office manager, full-time bookkeeper, and a full-time maintenance staff. So really just trying to hire our needs and gotten better at trying to predict what those needs will be with every new acquisition. But yeah, it's there's days where having employees can be a challenge. There's no doubt about that. But I don't know that I'd be willing to trade that for to a third party management headache and stuff like that.
Oh yeah, I mean, you can definitely get quicker results.
Yeah.
If you've got somebody that's an issue, then sometimes going through, the processes with a third party.
Yeah.
That's interesting though. Your first employee was a maintenance person, which is real interesting. That's, usually you hear somebody, well, I had to get an acquisitions guy so I could take some of the, or whatever, it's like, it's all these different ways, but that is very cool. That's very cool. And so, you have a headquarters office where a lot of the staff people are located as well?
We do. Yeah. I mean, obviously a lot of the day-to-day, the property management related stuff is done in the field. But they need a place to go, place to huddle, and we're tenants to meet. And I mean, of course we could do without it, but I think it's nice to have a place to call home and be able to work. Everybody can be able to work out of. And, those early years, my wife and I were doing everything out of our house, and,
Sure.
That was just old school mom and pop way of doing things. But, one too many times, you'd have a tenant show up at the house or things like that. And we said, you know what, this isn't, this is not the way to do things. So we got to buy an office and expand enough to where we've got no other option.
Now, did you buy an office building, or are you renting or leasing?
We bought it, and
that's pretty cool.
So it's funny how, when I decided that we needed an office, this was, I don't know, eight years ago or so, because we were working out of like storage spaces at properties and just, kind of making do of whatever space we had. But it was an office building, and a charity had owned it for years. It used to be an insurance agency, probably 30 years ago, but they decided to relocate their headquarters to Washington, D.C., and they needed to sell the building. Well, it just just wasn't selling. So they did an absolute auction, and I bought I was the only person that showed up to the auction. So I bought this building for like $40,000. It was like ridiculous. And I'm like, I walk out of it feeling like I stole it.
How many square feet is it?
Oh, gosh, probably all in all, it's probably about 6,000 square feet.
Oh, gee.
Huge. Yeah, it's huge. And it's kind of a funky layout, but for $40,000, now we put money into, upgrading it, making it look nice and things like that. So our basis was quite a bit higher than that, but still, I mean, I think we put another 45 into it, and, it's worth probably triple, what we have into it. So,
very cool.
Yeah, we found the need, and then the universe provided. I mean, it's just like, hey, there's this auction. It'd be a great spot. And
how many parking spaces does it have?
We've got about 15 spaces.
That's good.
Work vehicles, trailers. We actually have a tenant. So one of my prerequisites was I didn't want to have to just make this 100% overhead. So we do have I have a business tenant that rents some office space from us there, and then a residential tenant. So it doesn't cover our costs entirely, but it covers probably 80%, 90% of the cost.
Sweet. Yeah, that was good planning. That's great. And, doing what you've been doing this since 2001. Okay. So you're up at here, 20 years nearly as an investor. You must have encountered a lot of challenges along the way. I'm wondering sort of what major mistake, or maybe it was a couple of mistakes that you made early on that you've learned from and have since, sort of re-honed your operations to actually make your business better.
Sure. I think, a couple of things that stand out, the first one is just really trying to get better at hiring better people and building a culture. I think early on, I would just hire whoever, and it probably lost more money than I'd like to admit or even know, just by having the wrong people on the team, whether they, didn't know what they were doing, or they were incompetent, or both. And just, that probably cost us a lot more. So really trying to focus on figuring out how to be a better boss and a better leader, so we can hire in the right people, and build the right team. So that's one thing that sticks out to me. And then, the other was just, not just analyzing deals better, but really trying to run the properties and run the business, in the most profitable way possible. So sometimes we'd, get so focused on acquiring, but either not budgeting the right amount of work that was going to go into the property early on, or just trying to roll in, like self-fund all the CapEx, and that can just like eat you alive. And so I think some of those early years, I wasn't as focused on the profit of the property. I'm like, hey, I'm just going to keep buying and buying, and this business will take care of itself. And to a large degree that did, but if I look at it through the lens of, say, a syndication, the level of how we analyze the deal and we project, create our projections, we have to be very on point with that. And had I taken that level of kind of OCD that we do on a syndication deal back to like the smaller properties, I think that I would have been twice as profitable if we would have done that early on.
Interesting. Well, it kind of begs the question here too, because you're doing both. You're self-owning and you're also syndicating. What's your preference? What do you prefer doing?
It sounds like an easy out, but I really like doing both. So, for me, I mean, especially when you've done this a long time, I mean, I guess if we didn't do anything new, I mean, sure, I could just kind of coast along and I guess count our money, but I like to. I like the challenge of doing things new and differently. I like being able to provide value to investors and really seeing like, the kind of the glimmer in people's eyes when they get their distribution checks is a nice feeling. So I like being able to get into higher end product, larger product. So that's really fun to own properties like that. And I think it's a lot more predictable. So I have trimmed off a lot of the fat, a lot of the lower end product that we have. I've consolidated into certain areas and just, so I'm just, it's just like real life Monopoly, right? So it's just fun I still have fun with that kind of game of like, what am I going to sell? What am I going to buy on the stuff that we self-own? And that's just, that's still a lot of fun. So as long as it's still fun, I'll continue to do it. I like doing both.
Interesting. Wow. As you've learned too and gone through this process, what success, really stands out as something that really changed sort of the whole focus of your business?
I think for me, one of the things that I'm most proud of was just being able to leave my day job and sort of being able to create a business on my own terms. And, I think that's one of the things that, if some of your listeners that are, looking to leave their day job or have and kind of feel down about it, is that, real estate's I think it's the best business in the world because you can kind of create whatever reality you want. If people are happy, just, fixing and flipping a few units a year or investing passively, hey, it's getting them closer to their goals or helping them live the life they want. So that's just the thing I'm most proud of, is being able to leave a really good day job and kind of, I try not to miss, unless I'm out of town for something. I try to get my kids, drive them to school every day, pick them up from school, and do the things that, I missed in those early years, but the things that a lot of times, we take for granted if that people have to kind of like work a corporate job for a living, don't always have the luxury to do.
That's neat. Well, a lot of our listeners are folks that are 50 years of age and older. They are either approaching retirement or, they're already in retirement and they're trying to figure out this cash flow issue and being able to generate enough income so that they can whether it's sort of the long haul, people are living longer. There's also, new expenses that they may not have planned for in their retirement, like everything from assisted living to, healthcare costs and so forth. What advice would you have for those folks from your experience is a good way to generate that good, consistent cash flow?
Sure. I think one of the best ways to do that is to invest in real estate, of course. But, if you're retired or approaching retirement, you really have to ask yourself, do you want to deal with, the tenants' trash and toilets, is really to say that all the stuff that really causes you grief. And so, if somebody's at retirement age and they're sitting on a nest egg, how do they want to diversify, their income and their investments? And I think that, in a large part, whether it be syndication, hard money lending, investing in flips, or even if they want to go out and be take charge and be their own deal sponsor and start syndicating real estate, I think they're going to get far more consistent and predictable returns. And so, when I look at some of our passive investors as an example that, might be in their, early mid 60s, 70s, and they, they're used to getting a very low return out of the stock market in terms of the actual dividend that they're receiving every month. And then being able to kind of translate that into something that they're getting, 7, 8, 9% on, that's a big difference. And that can make all the difference in the world for somebody in their retirement. So I would just encourage, if somebody's thinking of those things and trying to think about how to maximize their returns, just, do your research, try to really vet, be it a syndicator or if you're doing hard money lending, vet that person, but you can make far superior returns and, have all the benefits of investing in real estate with, none or very, very little of the headache. And that's, I think, probably the best thing that anybody can do. And I say that because I'm partial to real estate because we see the returns and we see what it can do when it's run well and managed well.
That's a great point. Great point. You still sound like a fairly young guy here, and you've got some time ahead of you. What's sort of your end game? Where do you want to see your business go and grow, and what excites you about the future?
Yeah, so I will be 43 this year, which I know is still young. We've been doing this almost 20 years. Part of where I get joy from right now is being able to give back. I do a little bit of real estate coaching and mentoring, and it's a lot of fun to see as you're teaching newer investors, irrespective of their age, when the light bulb goes off and they're able to achieve their goals, that's a lot of fun. So that's some of the give back, I guess, is that, kind of being a mentor to those that are just starting. So that's a lot of fun. But as we get older, I mean, we're going to continue to travel and kind of continue to do the things that we like to do that are non-real estate related. So I mean, I think part of that looks like, getting into more of the syndication deals and some of the stuff that we self-manage, just continuing to, to sell off the smaller properties. So something that, maybe we have a glut of a lot of our bread and butter is the 20, 30 unit properties. And at some point that becomes, we've built enough equity, or you start paying those off to, kind of be that guy or that person for an up and coming investor, where we can hold the paper and we can, help them get their start, and they get the, they can kind of get into something a little easier, but we get the benefit as the seller of getting our price, and owner financing a property can be a great way to create passive income. So I think as we grow, I mean, as we dispose of some of our units, that'll be one strategy. The other thing is to continue to invest in things that require less management and less work, that as long as we have it systematized and good people with boots on the ground, we can continue to travel and do have that freedom that, real estate provides, and not be bound to, showing up to the office every day.
Great. That's great. Well, time's kind of zipped by here, and it's unfortunate because a lot more things I'd like to discuss with you, but I want to respect your time as well as listeners here that used to having me under an hour, for the most part. But this is what we call our wrap it up session, and we ask you a series of quick questions that you can share resources that you have used that might be of value to our listeners.
Sure.
So if you are you ready to wrap it up?
I am.
All right. Favorite real estate book?
Robert Kiyosaki's Rich Dad, Big Book of Real Estate.
Oh, okay. The Big Book of Real Estate. Excellent.
Yep.
How about favorite business book?
The one I've reread a few times recently is Principles by Ray Dalio.
A good one. Good one. How about most valuable website for success that you tap into on a regular basis?
Believe it or not, Facebook can be a good place. So I've found that some of the groups and the specialized groups on Facebook can be a great source of networking and success. So that's my answer, and I'm sticking to it.
That's great. That's great. Yeah, there's a ton of, especially multifamily focus groups now out there for people that are interested in that. That's great. How about a favorite app on your phone?
My favorite app is Slack. So I know it's more of a website, but we use the app, and that I found that helps our productivity for our team immensely.
That's great. Plugging all your different team members and so forth, the tasks in there. That's great. How about a favorite quote?
Yeah, so sure. One of my favorite quotes is by Jim Rohn. And it's real simple, but to me, it makes so much sense about taking ownership. And that says either you run the day or the day runs you. And so it's just, are you going to take life by, take the bull by the horns, or are you going to be reactive and react to everything that happens to you? So that's something that's always stuck with me.
Good one. Real good. And here's our $50 million question here. If you lost absolutely everything that you've worked so hard over the last 20 years building up, and all you had left was $1,000 in cash, what would you do with that $1,000 to rebuild your real estate investing business?
I would go to a real estate seminar. So I would take that $1,000 and buy a seat at some event, from some guru. But I know that the networking and the mindset shift that I would get out of that event would catapult me into greater success and help build that wealth back in double time.
Great. Great. Yeah, that's a tough, just finding the right guru, though, is key there.
Right. Oh, yeah.
So awesome. Well, I'm sure there's a lot of folks listening that would like to find out more about what you do and, even about your coaching program. And what's the best way for folks to reach you?
Sure. They can hit me up on email is usually the best way to get a hold of me. And that's simply jasonperro@yahoo.com. And if anybody wants to schedule a 15-minute strategy session or phone call with me, they can go on calendly.com/Jason Perro and book a 15-minute slot to just to strategize or chat about business and life and all that good stuff. Is
that a free consultation?
Yeah. Yep.
Oh, all right. Hey, we love freebies here at Old Dogs. Okay, that's great. That's cool. Wow. Well, Jason, this has been really, really good. What a great batch of information, and what a neat story you have too. It just, I'm sure the challenges, we didn't really go into it, but the challenges of balancing, at one point, you had your sales career, you have rental, you've got a young family, and and then today, of course, you've got this large portfolio that you're overseeing and growing, and trying to balance that all out has got to have its challenges. But it sounds like you've got it under control pretty well. Yeah, thank you very much. It's we're really proud of it, and it certainly doesn't come without its challenges, but very grateful to be where we're at right now. Well, that's neat. Well, we have a tradition here that all of our guests get the pleasure of getting involved in, and that is to close out the show with your best old hound dog howl. And I don't know how many hound dogs there are in Erie, but hey, there's got to be some around somewhere. So if you are ready, can you close us out with your howl? Sure. Howl! All right. Well, thank you so much, Jason, for being on. It has been a real pleasure to have you. All right. Thanks a lot. I appreciate it very much. I also want to thank all our Old Dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note, Old Dog listeners, everything presented here today and everything that Jason shared with us, including some of the links to resources, can be accessed in our detailed show notes on the Old Dogs website at olddogsreinetwork.com/blog, and you're going to look for the interview with Jason Perro. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.